Hey, this is Stuart Grazier, and we're going to talk about mortgage note investing today. So we'll start with what is a mortgage note. Essentially, a mortgage note is a promise to pay, and it's secured by real estate. A lot of times you'll hear other terms that basically mean the same thing. You'll see seller financing, or owner will carry the note, or private lending, or even a wraparound mortgage, which is a mortgage on top of another underlying loan. So a mortgage note is an asset, and really there's two parts to the mortgage note. The first part is a promissory note. And this is basically the contractual obligation for the buyer to pay the owner. It can be transferred. If you look at the banking industry, banks do this all the time. On an underlying loan, they'll then sell it off to another bank. This could happen to you quite often, actually. You could buy a home conventionally, and first your loan will be with Wells Fargo, and then you'll get a big note in the mail that says your loan has been sold off to Chase Bank or something like that. But basically, the promissory note is saying that I promise to pay X amount of money a month at a percent interest rate over the course of the year, and it's amortized over a total of 15 years or 30 years or whatever that may be. The second part of the mortgage note is the deed of trust, or in some states they just call it the mortgage, and this is basically the lien, and this is the security of the house, and it's recorded at the courthouse. And this is basically saying, hey, if I don't pay the mortgage, then you as the lender can foreclose on me and take ownership of the house. So as an investor, strategy for buying mortgage notes, you have to look at it at two different angles. On the promissory note side, you have to look at it as in, hey, am I going to be happy if I'm repaid? Is the interest rate that I receive every month worth my investment? And on the other side, on the deed of trust, you have to look at the house and say, hey, will I be happy if I'm not repaid? Is the house itself a good investment? If I have to take ownership of it, is this a good investment? Would I want this house? If you can say yes to both of those sides of the equation, then mortgage note investing is a good strategy for you. Oftentimes you're going to be happier if you don't get repaid, if you do take ownership of the home, and lots of people use this strategy of hoping that you foreclose on the property, and it's a loan-to-own type of program. So essentially, mortgage note investing is hassle-free, and it's secured by real estate. You look at bonds, and essentially this is what it is. A mortgage note is a type of a bond. You can compare that to government bonds or treasury bonds or corporate bonds. And those type bonds, if you look at it, if the government doesn't pay the note back, then what do you get? And really the answer is nothing. There's nothing secured to that government bond or that corporate bond. And most of them are really low. They're normally at 2 to 3% interest. You look at the case of Detroit, that municipal bonds. They went bankrupt and they failed to pay back investors. You look at the country of Greece. Their economic state is failing, and they're having a hard time paying back those government bonds. So compare that to a deed of trust or a mortgage, and it's much better of an investment tool. If you don't get paid back, then you get to foreclose on the house, and you get to take ownership of it, and there's still a large potential that you are going to win on either side of the equation there. And the interest rate is quite a bit higher. It's normally 6 to 12% interest. So how do you as a lender make money? We've kind of touched on this already, but really the main portion of your income is the interest income that comes in on a monthly basis. You could make money off of loan origination fees, but this is where you would be starting the loan yourself. If you own a house and then you go and sell it through seller financing, you could charge some loan origination fees. You could purchase the note at a discount if you're buying it at less than face value. An example would be there's a $100 note, and you could buy it for, let's say, 96 cents. That 4 cents equity is an immediate discount to you, and you could then resell the note. If you're buying it at 96 cents and it's worth 100, and if you sell it for 100, then there's your profit, that equity. If you do have to foreclose on it, the equity that you have in the deal, and normally we don't buy anything or sell anything that's more than 75% loan to value. You resell the property, that 25% equity is immediate upside to you as taking on the ownership of the property. You could then sell it off either traditionally, or you could sell it again through seller financing and start the process all over again. If you don't want to sell it, you could just hold on to it and you could rent the property. So why own mortgage notes? Really, the easy answer is great income, 6 to 12%. The rewards versus the risk is excellent. It's passive income. You really don't have to work very hard to receive a monthly paycheck in the mail. You're not a landlord. You don't have to deal with all of those hassles, and it's relatively liquid. If you have to get cash out, I guarantee you can find another investor that you can sell off your note to and cash out fairly quickly. There's lots of potential for upside. You can sell off notes over and over and over again. There's always a chance that the house itself, the value is going to increase. So you're building equity along the way. And, you can make bite-sized investments with mortgage notes. Like I said earlier, the average deal is anywhere from $60,000 to $120,000. But we can fractionalize those notes into smaller bite-sized investments for someone who doesn't want to, invest that big chunk of change. And lastly, it's predictable income. Every single month, you can expect the same amount of money coming into your bank account. So why is now a good time? As most of you know, home prices are increasing every month. Really, it's a seller's market right now. That whole adage of buy low and sell high is not now. Market is on the uprise, and cap rates for commercial real estate are low. So, buying commercial properties probably isn't the best either for you right now. And for the conventional buyers, financing is still pretty difficult. Although the interest rates are lower, it's still a fairly tough process to get that conventional loan. So now's the time to look for those buyers who really can't get the conventional loan but are still interested in owning a home and want to go through the seller financing opportunity. There's always economic uncertainty, especially today. There's always rumors of more crazy things to happen. Lots of government stimulus over the last couple of years. Government bailing out big corporations, and so putting your money in the stock market is somewhat of a gamble these days. And mortgage notes are easy for you to be geographically diverse. As I said earlier, most of the homes that we do are in Texas, but you could be owning these mortgage investments from California or New York, or really anywhere in the United States or even out of the country. So why Texas? Texas is a no state income tax. This is good for both the borrower and the lender. And we're not going to get into really all the legal details of income tax and tax strategies and all the foreclosure laws, but foreclosure laws is another really good reason why you want to own in Texas and why you want to lend in Texas. Same goes with being a landlord. owning the house and being the landlord, there's lots of laws in place that will help you as a landlord versus the renter. And we have a full team right there in the Dallas-Fort Worth Metroplex. We have access to legal, the rehab team, the brokerage, the title, and we have a third-party servicing company right there. DFW is really a top-growing metroplex in around the United States. It's very affordable. Prices are continuing to rise, but still very affordable in comparison to a lot of the other states around the U.S. The price point is still fairly low in comparison to others. And there's less competition for lending. There's a lot of money out in California and in New York, and there's just quite a bit of opportunities for investment in Texas. So here's some of the general guidelines that we look for. We're offering loans and doing seller financing in the state of Texas. We offer first position deeds of trust. That means you are in the first position. If you have to foreclose on the house, you're going to be the first in line to get the property. All of them are single family homes, most between $65,000 and $125,000, and our max loan to value ratio is 75%. We like to have our mortgage payments less than what the equivalent of rent would be. One, because that's enticing to buyers. You can show them that, hey, it's going to be cheaper for you to buy a house than it would be for you to rent this same house. But then again, it's also good for the lenders. If you do have to foreclose, you're in a good position to then rent it out and still make a really good return. We always want the buyers to have a debt-to-income ratio of less than 45%. We always just make sure that there's proper title insurance, and all of our loans are then serviced through a third-party servicing company, and that is paid by the borrower. The title company and underwriting is all done through professional services, and we make sure that they're amortized no longer than 15 years. So at some point you will be getting your money out if the borrower goes the entire due course of a 15-year loan. So here's a quick example of a property that we currently own over in Fort Worth, 7820 Xavier Drive. It's a 3-bed, 1-bath, 1-car garage, about 1,100 square feet. It's built in 1982, and we did a full rehab on it. That area potential rent is $1,050 a month. The borrower, a couple bought it together, owner occupied. The value of the house was about $94,000. We sold it for $92,000, and they brought some cash to the deal. So the underlying loan is $70,725. So that gives us about a 75% loan to value ratio, and we sold it over 15-year amortization at 9.65%, which gives you $744.94 a month of principal and interest. So the borrower, again, couldn't get a regular loan, had a lower FICO score. Monthly income was fairly good, and debt to income ratio was less than 45%, which is what we like to see. So if we took this note and we fractionalized it and sold it off to a couple of individual owners who wanted to bite size off these loans, we could sell it off, and this is just an example of selling it to 4 different owners. One buying us $10,725 of it, one for $20, one for $30, one for another $10. So the percentage owned there would be based off of the amount invested. Your monthly payment would be based off the percent owned. And then if you look at the calculations there, that percent of return is a cash-on-cash return. So your annual income divided by the total month, or the total invested. So the note buying process, first and foremost, you just tell us that you're interested in looking for notes, and when we have one come available, we'll let you know. We'll give you kind of just a snapshot of what the deal is with the deal, and you review it. You can ask us questions, and then next, if you really like it, then we need you to get to control the deal, and that's basically saying, hey, I want the deal, sign me up, and we'll start going through the due diligence process. We'll drop all the paperwork for you, send it to you, let you do a final review, let you do your own due diligence, and then we'll go to closing. You invest in the property, and then we'll transfer the deed of trust over to you, and then bring that to the note servicing company. Get you all set up with a note servicing company right there in the Dallas-Fort Worth area. And then really it's just sit back and watch it grow. The third-party servicing company will take care of everything for you. Once the check comes in, that'll transfer it over to your bank account. If payments are late, the third-party servicing company will call the owners for you and help you out with that. So you really are hands-off on the whole process. Okay, so that's it for introduction to mortgage note investing. If you have any questions, you can email me below at grazierinvest@gmail.com. And thank you for your time.